For our next segment, please welcome the panel on the evolving landscape of private markets, moderated by Managing Director of EMEA at Kaya, Laura.
Good afternoon, everybody. My name is Laura Merlini. I'm responsible for Kaya's EMEA's operation, Europe, Middle East, and Africa. Out of Geneva, Switzerland. It's a pleasure to be here, and it's a pleasure also to have this partnership with Milken, and most of all, welcome Kaya members that I've met during these previous sessions. Today we are going to discuss something that is very topical for the Kaya Association, and especially because Kaya is not only active in the credentialing space, we always try to push the industry forward, not lingering in views of the past, but really discover what's new for both the LPs and the GPs. To this extent, I welcome our wonderful and brilliant speakers. I would like them to briefly introduce themselves in the context of what we are going to discuss. So Klaus, I will start with you.
Yes, my name is Klaus Hommels. I'm the founder of Lakestar, which is one of the bigger VC funds. I do this since 20 years. And beside that, I'm also chairing the NATO Innovation Fund, where we collected 1 billion from the NATO member states to invest in technologies that enhance the defense capacity of NATO. Yeah, this sector has gotten a sort of like a popularity lately. So you can imagine that topics like innovation and sovereignty are pretty much on top of my list.
Thank you, Klaus. Scott.
So I'm Scott Spielvogel, co-founding managing partner of One Rock Capital Partners. We're a buyout fund that is focused on the industrial sectors of the economy, been around since 2010. About 8 billion of assets under management. And within those areas, we like the ugly, hairy, messy deals, so we're definitely value investors.
Thank you. Lauren.
Good afternoon. My name is Lauren Goodwin. I'm the Chief Market Strategist at New York Life Investments. New York Life Investments is a $750 billion global asset manager. We're the investment management arm of the New York Life Insurance Company. And we look across public and private markets, debt, equity, and alternatives. And we're a multi-boutique model, meaning that each of our investment strategies are very local, specialized to their asset class. I sit at the corporate center with the opportunity to work across and with these investment teams, identifying key convictions and best ideas. And so these questions of how the private markets are evolving are very central to my work. And I will just say that though New York Life Investments has been here in the region for more than a decade, it's my first trip to the region. And so I'll just say that the generosity of spirit and dialogue and insight that I've had here in my first week in the region has been second to none. So thank you for your welcome.
Thank you, Lauren. David.
Yeah, my name is David Steinbach. I'm the Chief Investment Officer at an organization called Hines. We're a privately owned real estate investment manager that operates in about 30 countries around the world, have about 100 billion under AUM, and obviously the intersection of private markets, both in terms of the capital we raise and deploy is center to my life, and so excited to be here today.
Thank you. Andrew.
Andrew Weinberg, founder and CEO of Brightstar Capital Partners, a 5 billion AUM middle market private equity firm focused on families, founders, and entrepreneurs, and control positions in what is the greatest generational wealth transfer we've ever seen.
So thank you. Today we are going to discuss the evolving landscape of private markets. To facilitate also grasping intellectually what will be discussed in this session, we've decided to divide it in 3 parts. One is really the macro, understanding what's happening, the macro trends, and the geopolitics, and how these trends are affecting asset classes, alternative asset classes. The second one is a very recent topic, but very present in our minds, that is the convergence of private and public markets. And the third one is innovation. And what does it mean, innovation in this actual industry? But for the macro, I couldn't be luckier to have on stage Lauren, because Lauren, you're an expert. In your life, you always turn these macro trends, macro views, geopolitics, feelings into strategic investment decisions. Maybe if you can tell us the trends that you've seen recently and how these are going to affect our industry.
Sure, thank you, Laura. Despite all of the uncertainty of the past 3 or 4 years, as many of us are putting forward our year ahead outlooks, I've noticed even more uncertainty than normal. But I think that we can anchor as investors on a few key turning points that are impacting not only allocation in the private markets, but also the evolution of the private markets over the next 3 to 5 years at least. And the first, which has been discussed quite a bit today already, is the global megatrends shaping the asset management industry as a whole. By this I mean digitization and AI, electrification, supply chain reglobalization. These megatrends are driving an incredibly capital-intensive phase of investment, which from a private markets perspective presents interesting allocation opportunities, but just from a macro level creates a constructive economic backdrop and probably puts a floor on inflation and interest rate outcomes for the private markets as well. But importantly, on a cyclical basis, a second transition we're seeing is in the interest rate cycle. Global interest rates are moving lower, even if in some cases, and specifically the US, it's happening a little bit more slowly than maybe investors thought. And this is so important because, for starters, it extends the cycle across many of the countries and regions where private markets investing is so central, like the US and Europe. But it also improves borrower health. It creates an opportunity for valuation bottoming, a good investment timing opportunity, and it creates an environment where debt and equity can perform well at the same time, which I think we'll talk quite a bit about today. But the interest rate lowering cycle is also prompting or contributing to a third transition we're seeing in private markets, which is that deal flow is starting back up. And though the interest rate cycle plays an important role in this, sponsor pressure is also playing a role. But I will say that this transition isn't happening before some structural change has already taken place. The sluggishness of deal flow in the last couple of years has led to a real evolution in the secondaries market, becoming a more stable ecosystem for the private markets, making the whole private market system more mature in many ways. And then finally, a fourth transition, and I hope we get to speak about this more in the second and third phases of the panel, has to do with the democratization of private assets. When interest rates were low, many more investors had to get comfortable with private assets because complexity and illiquidity provided an opportunity for higher return when there wasn't any elsewhere. But if that's a first renaissance for private assets, we're underseeing a second one now, where more investors are looking for the, call it real economy or Main Street levers of value creation that they're not finding in the public markets. More different types of investors are looking for access to the private markets, and that's driving a focus on potentially liquidity, on product innovation as well. And so these are the trends that we see really shaping the private markets landscape and that drive, from my perspective, a very constructive opportunity to allocate to the private markets depending on the geography and the asset class.
Depending on the geography of the asset class, that you nail this down. Can I stay just a little minute with you? And can you delve into this sentence that you said? So what's happening? Are you seeing, Europe behaving differently from the US going forward? And if so, why? And what do you see? And also in this part of the world.
Sure. Well, we've heard from several of the panelists today that there's been a real focus on US assets lately. And that's in part because of just how strong and reliable US growth has proven to be, the depth and liquidity of US capital markets, et cetera. But that's, of course, causing a bit more sluggishness in the interest rate cutting cycle. And one of the areas where we're seeing this play out in the most pronounced way is actually in real estate. It's, of course, a more cyclical asset class, even in the private markets. And so for a combination of reasons, the stability of the interest rate cutting cycle in Europe, but also the differences in regulation. It's been a cause of potentially a perceived sluggishness in innovation in Europe, but in real estate we've seen a real potential benefit because the environmental efficiency, technological capability of office space, just as an example, is keeping rents higher. And so we've seen that be that difference geographically be a real boon for investing in real estate in Europe. I do believe that the US will follow. I think that that's a transition we'll see over the course of 2025. But in Europe, that allocation opportunity is already getting underway.
So thank you so much. We go back to the European corner with Klaus. Klaus, how do you see this impacting technology, innovation, and the role of the NATO fund?
Yeah, look, so the whole situation with the war in Ukraine basically means that Europe has to beef up its capacity. And the capacity has to basically, when you look at 2014 till now, not fulfilling the 2% basically led to savings of 1.6 trillion. So this 1.6 trillion haven't been invested in the heavy metal infrastructure equipment. So now we do not have capacities, no factories to do this. So even if we wanted in Europe to scale up the defense equipment, we cannot as quickly because there's always a lag time. That means that for that reason, you do have to suddenly get into the new technologies. And not only for that reason, but also the new technologies have proven to be way more efficient. So if you think about a 1,000-euro drone, taking out a 10 million Abrams tank, which means for the Ministry of Defense, do I buy another 10,000 drones or one tank? So the innovation there, led by the examples from Ukraine, have very clearly demonstrated that the next phase of modern warfare, of modern defense, will mainly happen with technology. So and once you get into that, you have a always faster cycle. So you have drones, then you have the counter drones, then you have jamming, then you have spoofing. So everything develops very, very quickly and becomes an arms race in the sense that you have to always equip yourself with the newest technology. So another example how that develops. So I was the last week in Kiev visiting some of these startups. And one startup that didn't exist 2 years back, they basically build speedboats, unmanned speedboats that have LiDAR, radar, what have you, and a payload. And this startup took out 30% of the Russian fleet in the Black Sea. So that means a startup with new technologies is responsible for basically taking the Russian fleet at bay and therefore putting Ukraine in a position to export grain, which otherwise wouldn't have been possible. So there is a huge lifeline for the Ukraine based on technology that has emerged as essential to have a weight on the outcome of the warfare.
But I read your article on the Financial Times, so for you there is a feeling that we lag a little bit behind and that we should do more and better on the defense side as a European.
So that is not a feeling, this is unfortunately a pretty heavy fact. So basically we have 34%, we invest 30% less than in 2014. So we have something like 34% less people in the army than in 2014 or 1992. We had in 1992 18,000 tanks, now we have 3, and we have 3,600 fighter jets, now we have something like 600. So there is a huge history of trying to take advantage of the peace dividend, which actually leads to the fact that the current equipment is insufficiently staffed and insufficiently enough to take the challenges that we will have.
We talked about macro trends, we talked about geopolitics, and as a little part of geopolitics, can we touch on immigration? Because it's affecting directly your business, right? So how do you see the future for your business?
Yeah, so immigration is a big topic that we talk about, certainly for all of our US-based companies, and we're investing primarily in the US and in Western Europe, at least that's where our companies are headquartered. And quite frankly, in the service industries, especially in the industrial services businesses that we own, oftentimes the biggest constraint on growth is the availability of labor. We have a super low unemployment rate in the US, and we do have immigrants coming to our shores. However, the policies have not been such that they've been allowed to work and add to the workforce and allow our firms to employ those people productively. And so we've had to get creative and try to tap into new sources of labor, whether it's people coming out of the military or other sorts of programs. And then in our manufacturing businesses, in some cases, we have no choice but to automate some of those processes because we just can't find the labor for some of the entry-level positions. And so it has to be some kind of an automated or robotic solution for us.
So again, investing in technology and innovation. Andrew, to you directly, the middle market business, because you take care of that part of the business, and it's resilient in volatile conditions. So how do you see, how this can translate into sustainable growth, given the macro trends that we've discussed?
Sure, thank you for the question. I think 2025 will be another interesting year. I hesitate to have a crystal ball, but I think volatility might be more the case. I'm encouraged when I come to the GCC for the dynamic nature of the region, for the progress, for the significant growth in the region. And we've had a chance during this visit, we've come here a number of times to meet with a number of family-owned businesses while we've been here and see similar business models to what we operate. If I take the backdrop of what we're serving, our business is serving the $90 trillion wealth transfer of one generation to another, primarily with US businesses, but this is a global trend. To put that in perspective, it's more than 100 times the dry powder in private equity right now. It's 1.6 times the entire market cap of all US stocks put together. But we have a couple of tailwinds that we appreciate during this time of volatility. One is just the aging of baby boomers. This is actuarial. Mike spoke this morning about different regions and populations and the changing rates of growth. Families don't wait to age, and on average, 60% of families don't have a succession plan. So we come in there to serve those markets and really facilitate bringing capital to be a solution provider. That tailwind is not changing at all. The second is the middle market. During the GFC of 08 to 10, large companies shed 4 million jobs, and the middle market added 2 million jobs. So again, we're encouraged by that. And I'd also say I'm encouraged that despite the volatility of elections, where I think half the world's voting populations in the last 12 months, including last night, said we want change in a significant way, I'd also tell you in the US market, what we're seeing has been, in the last few weeks, an incredible amount of stability in the business environment. And customers are telling us we're going to spend, okay? Deals are happening. We had a record year for our firm of deal activity, both investing and exiting in 2024. So if that happened during a relatively volatile time, I'm encouraged that 2025 should be relatively good.
Thank you. David, we go back to what Lauren said at the beginning, so the big macro trends, and you defined the 4Ds: demographics, deglobalization, deleveraging, decarbonization. How these 4Ds are affecting the real asset space?
Yeah, I think, before I hit that, I do want to comment on something you said, because I do think that when you look at some of these bigger trends, and the numbers are hard to conceptualize, we're talking trillions, but some similar stats in terms of what's coming to the private markets. And I think it's really interesting to think about these shifts. And I think that smart investors are doing similar things. And how do we capture the demand, but more importantly, how do we create the right financial wrappers that meet the needs of these new clients that are coming to market? When I look at the public markets, and I look at in 2008, there were about 8,000 public companies in the U.S. On the stock market, and today there's about 4,000, so it's half. Meanwhile, global wealth has doubled in size. And then when I look at the concentration of returns in the public markets, about 85% of the stock markets in the United States are made up of the S&P 500. And it's really been 10 stocks have dominated. There were about 100% of the returns last year. And so you think about that concentration risk that investors are taking in the public markets, and they're doing it because of perception of the liquidity that they get. So they're overvaluing, in my opinion, the liquidity. And that to me says that there's a whole world in the private markets that they're not tapping, and they're focusing really on just a few stocks. Second point is when you look at new demands of capital, so this transfer of wealth is undeniable. I think the other element is this shift between institutional investors and non-institutional investors. And the institutional investors, which is certainly the area that has dominated the real estate world traditionally, is about $27 trillion market. And the non-institutional investors are about 3 times that size. It's growing at twice the rate. And the institutional investors are about 30% allocated to alternatives, and the non-institutional about 4% allocated to alternatives. So you have a market that is 3 times the size, growing twice the rate, significantly underallocated compared to institutional investors' allocation to private markets. So we see all of that as tremendous demand that is coming into the private markets and specifically into real estate. So then when you apply those kind of mega trends, if you will, into our world, the other element that is happening of kind of these big trends, I think demographics is one of the biggest ones that you can't ignore. And I think it's causing us to have to rethink the built environment and how we're serving the communities that it's intended to serve, because the nature of those communities is changing because of demographics. And in the West, the working age population is peaking in most places. And so that's going to have a lot of ramifications for how we work, live, play, and what we want our cities to look like. And so again, I think there's a tremendous demand to build that for the next generation that's coming.
Thank you. The other topic that Lauren mentioned was this access to real growth and real economy, and that's a natural segue to the convergence that we are talking about public and private market. There is a nice video that has been released by the CEO of Apollo explaining really in a sophisticated way but simple way what's happening now. So I invite you to have a look. What are you seeing in this convergence? What's happening? Because obviously the LP has always this, LPs have always this aspiration to, to have the risk management in place, to have diversifications, liquidity aspects. DGPs have other tensions. They have, the value creation, they have the pricing, they have the operational efficiency. So what's happening in this convergence?
I'm sorry, say it. What's separating within the convergence? Sorry,
this is for Lauren.
Oh, sorry.
Yes, sorry, apologies.
Yeah.
I will come back to you in a second. There is another convergence I want to talk to you about. No.
No.
So maybe
You want me to jump in?
Yes, of course.
So public and private markets, I think it's really, really interesting. Years ago, as you referenced, the 8,000 public companies shrunk to 3,000 or 4,000, depending on the number. I can tell you today, I can't think of a family-owned business that wants to be a public company. And 20 years ago, they all aspired to be public companies. That was a sign of success. Today, the sign of success is not having to go public to access capital. And think about the sophistication that has been driven by large allocators, large asset managers. This region has been a key protagonist in this convergence. And if we think about the knock that has always been on private markets has been the illiquidity. Well, with the amount of secondary funds that have been raised, I'm actually not sure there is any illiquidity for a sophisticated investor, and you can get a mark to market on any given moment. You probably eventually can trade it on a nanosecond in terms of a relatively what was called an illiquid or private market position. I think the private markets have benefited from being able to get their work done out of the scrutiny of the public eye. That doesn't mean without the governance, but without telegraphing the playbook to all their competitors. Now, the flip side is, and I've taken companies public and served on public company boards, there's an incredible governance framework that really comes out of the public markets. And I think that's actually a great thing. I think that keeps bad actors out of the market, right? That trust factor. We happen to run a business in the US that's an auto auction business, and we don't own one asset. We transact 1 million times a year, okay, in terms of transfer rate. People trust that when we give them a vehicle, it's the one that they think they bought because there's a perfect report on that. And when I came to the region, people said, depending on the country, you may or may not trust it, and that's a global theme. Same thing for public companies, and I think private companies. I think if you trust the governance of that private market manager, you're more likely to want to acquire that business because you're less likely to think there's a problem, there's something that I don't know. If I fast forward 5 or 10 years to this room, I don't even think we're going to define it like Mark Rowan has as any difference of public and private markets.
Excellent. So before I go back to you on the topic of governance and to you on the convergence I was referring to, Klaus.
Yeah, look, in the venture space, you have seen with venture becoming more popular, a lot of companies like Setter Capital and have emerged, and and banks have also consolidated. So there, JP Morgan bought some kind of trading places. Yeah, UBS is with like 2 trillion assets under management. Yeah, in the private wealth department, they would basically be very, very capable of being a market maker. So there are several trends in that direction, and at the at the top end with brands like Airbnb or Revolut, there were a lot of trading before they actually were listed. So I think this is a trend which, especially at the very high end of the very well-known B2C companies and the very which are brands, there are the borders between public and private, they blur more and more.
Thank you. I would like to know, in terms of, because you maybe are given your peculiar spot in the industry.
Kind, peculiar. It's kind.
Yes. So the pace of non-core asset carve-outs is accelerating. How does this trend impact private equity, Scott? So I'd like to understand in the technicalities of that.
Yeah, so in many ways, some of the public actors out there that are acting in public markets are driving private capital activities, and we see that in our business. We do a lot of corporate carve-outs. And so for example, when Elliott takes a stake in Honeywell and starts to agitate for a division of the business or a shedding of a non-core asset, that creates deal opportunities for folks like us, especially for big industrial conglomerates that may have a division which is dilutive to their growth strategy or dilutive to their margin strategy going forward. And so it's that discipline to try to maximize share price that oftentimes enables people like us to take those assets off their hands, invest the kind of capital that we would invest to grow that business as a standalone entity, whereas within the context of a big corporate conglomerate, which may have other priorities, wouldn't get the same kind of capital. And that's important in a deglobalizing economy, because there needs to be, when supply chains shorten, there needs to be local manufacturers making things for the local market. And that's where we come in.
No, thank you. Yes, go, fantastic. Yes, we got Lauren back. Okay.
So there's a source of stability historically that comes from the public markets, which is that in order to become public, to go through an IPO, you have to have undergone so many different forms of value creation before you get there, right? And so by the time you reach the public markets, you've been tested a few times, maybe more than a few times. But the challenge, and this is especially true in the US, but true globally, is that means that the convergence of opportunities, like you were mentioning, and the concentration of equity market opportunity just gets smaller and smaller as markets get bigger and bigger and more cash gets into the markets over time. And so investors are recognizing this, including retail investors, mom and pop investors. They're acknowledging that the sort of logic behind equity diversification, as an example, that you would have large companies and small companies in your portfolio. Small caps in the US markets and in the European markets, they're not small companies. And so to get access to those stages of value creation that really diversification was built around, there's an increasing emphasis on not just the private markets, but the middle market and lower middle market companies that my colleagues invest in as well, that are involved in those layers of value creation. And so the combination of that interest, but also interest in other aspects of the private markets, like the opportunity for income generation, are driving a real focus on product innovation in the markets, and I know we'll speak about innovation in a moment. But this focus on innovation and the demand for innovation and sort of the excitement around the private markets is pushing more and more capital into this direction. And I think that can be a very positive thing, but it's also a reality that creates more competition in the space. more capital, especially in the large and mega cap opportunities in the private markets. And so one where investors, if they're really looking for those phases of value creation, have to be very selective as well.
Yes, and having, educated investors and being able to run due diligence, which is just the key. So going back to that, I kept it vague, the convergence. The convergence I was referring for the real estate and the infrastructure, because it's happening, and it's happening now, and it's another type of convergence, but I just like to pick up your brain on that.
Yeah, it is really interesting to think about that. So infrastructure and real estate, they're both, they both have existed, for a long time. I felt like real estate has been kind of in the back corner that has the desk that, it's been something that people have obviously thought about, make allocations to, but it has not been center stage. Meanwhile, infrastructure has captured a lot of capital over the years, and there's been tremendous demand. But it's interesting to think about what's happening in the economy right now and the things that are changing and how those two things are converging. So let me just take some examples here. So as an example, the AI boom that is happening right now is causing a data center boom. That data center boom is causing an energy shortage and real issues. So in a lot of municipalities around the world, you cannot build a data center today without showing how you're going to provide power for it. So the constraint is power. The electrification, the example, which is really related to decarbonization, is causing a strain on the grid. And there's a lot of examples of the different regulatory authorities are talking much more about that. And for the first time in a long time, we're having conversations about the grid, which is something we've all taken for granted for a very long time. Now, when you think about issues like the grid, power, these fundamental things that are going to take a while for the infrastructure, for new power plants, these things do not just show up overnight, right? These are complicated, expensive, long-dated, regulatory issues that just are going to take a while. Meanwhile, you think about real estate, and it's a distributed network of physical buildings spread around centers of demand. And you think about how they could be part of the solution to helping stabilize the grid. And just one example that we've thought a lot about in terms of how to do this well, it's how to rethink data centers and how to bring it closer to energy sources. And there's some engineering things that are in the way of that will get solved. But the second is, how do you think about stabilizing the grid through storage, right? And what does battery storage distributed through our cities? And are those new sources of revenue for the built environment too? And so when you begin to see these as more of a unified solution set to solve problems, I think it does get really interesting. But it's a different way of thinking that the industry hasn't thought historically.
May I add on to this, because I completely agree, and I think it's a brilliant example of how a trend or a combination of trends can cascade through asset classes and ideas. We see this, I hate to talk about European real estate twice, it's really not intentional, but we see this as well, let's call it a regulation difference.
Yes.
In the US, we don't yet have a framework for thinking about artificial intelligence in terms of data security, privacy, et cetera. In Europe, there's a broad framework, and one of the things that's really a focus of this framework is privacy. And one of the realities of that privacy law is that each country, despite the sort of borderless or semi-borderless state of the Euro area and the EU, each individual country needs to have their own data center for these privacy purposes. And so if you think about how a factor like that then cascades to more demand for everything you've outlined, the real estate, the data centers, the assets that go into creating that reality, the energy, it's so capital intensive, and it takes time, but it's again one of the reasons why when we think about even just elementary investing concepts like growth, inflation, will these trends continue? It seems, I think it's a really important question to ask, will these trends continue? And from my perspective, it's very clear that we have a long runway on these ideas.
Yes, thank you. And Andrew, you had an opinion on data center.
Yeah, I was going to talk a little bit about, you bring up AI. I have a question. You don't need to answer it from the audience, but if your first search move is Google, you're like I was at the start of this AI journey, and my kids pointed out to me, if you're not starting with a generative AI tool, you're part of the old generation, okay? So that's like the first part of the journey. At our firm, we really embrace for our middle market firm, investing firm, and for our portfolio companies, embracing AI, okay? But it takes a backdrop and a framework. I can tell you that every company that we've invested in does not have the infrastructure or backbone to support the use of AI tools when we invest. So the first part is just building that layer, that common framework to be able to harness data and then use the data, okay? Big companies already doing it. These middle market businesses, tens of thousands of them, generally are not. If they have an extra dollar, only 1 out of 8 times are they spending it on IT in general. The second step was enabling our entire investment team with 2 generative AI tools and training us on them, okay? So that's a real journey, that's a commitment. We've worked with some third parties, and we've actually installed it in 2 of our most significant companies. I'll give you one quick example that everyone can understand, especially myself. We move again 1 million cars to this auto auction business, okay? Sounds very simple, but the common part was all these were family-owned businesses stitched together that didn't have a common backdrop. The second part was no part of our pricing was driven by an algorithm, but until you harness the data, we couldn't then use AI to help us put a pricing algorithm together. Airline industry did this decades ago. We're just putting it in now, but using AI to do that. The second part is, if you want to scale up a business, you don't want to double or triple your headcount in your sales force. So we have AI working overnight to let the customers know, if you transacted here, you're probably going to want this, and we let the AI do the talking. Those are just very simple use cases that have driven significant margin expansion just in that business alone. I'm excited for the journey. I'm not going to tell you that we're going to put the AI on autopilot to let us run our businesses, but it definitely is helping us do something that we're not seeing a lot of our competition doing right now.
That goes to straight at the heart of the topic of innovation, and we have 10 minutes to discuss it. And maybe, Lauren, you can set the scene about innovation and how we stand with innovation.
Sure, we've talked a lot already about the changing demand structure for private assets, and that requires some innovation in product types, the structures that we use to access private markets. And again, even retail investors are acknowledging that they don't need 100% of their assets to be liquid 100% of the time. When it comes to this product innovation, perhaps my colleagues on the panel are better suited to explain some of the different examples and ideas, but there is a trade-off between one of the benefits of private markets investing, which is an illiquidity premium, and the liquidity that many investors want. And they want that liquidity for lots of different reasons. In some cases, it's just a preference for some quarterly distribution. That's very popular here in the region, in fact. And in some cases, it's the perceived lower risk that liquidity provides you. If something goes wrong, you can get out. But the reality, and again, the return benefit for private markets is sometimes, or at least a layer of that benefit, is in the illiquidity itself. And so for investors, especially in the retail space, that are looking for more liquidity, there's just an element of buyer beware, of knowing what you're buying, because an illiquid strategy is not liquid. A illiquid strategy does not have daily liquidity. That's the point. And so at best, you'll be trading off some of your return. At worst, you create a structure that doesn't do exactly what the investor thinks that they're getting into. And so as we think about the innovation in the space, the evolution of the space, we really like structures that provide liquidity, but perhaps on a more reasonable basis, like a quarterly basis. Evergreen structures, for example, as an opportunity to combine, mostly equity, but a bit of debt to provide some of that liquidity, I think is more, at least in the moment, more reasonable in the space. But we also see even more standard private market structures like GP stakes as an example, providing more of a hybrid structure that gets that exposure. I do believe that these asset classes will continue to democratize. It'll be an important source of capital and allocation to the space. And I'd be curious how my colleagues see those sources of innovation evolving further.
Yeah, I think there's a big opportunity to innovate on the wrapper, the product wrapper.
The
and I
vehicles.
think some groups are going to do that. I also think there's an education moment too, because the reality for most people, they really don't need, they've been trained for something they don't need, and so they need to be retrained about what matters, and concentration risk, the points I made at the beginning. But third, I think that what we're seeing, at least in this last cycle, so real estate has gone through a cycle, and as interest rates went up, liquidity dried up. And but we were able to utilize a secondary market for secondaries, particularly in Europe. And it was interesting to see that emerge, because I didn't see that in the GFC. And the secondaries market, again, I saw it specifically in our European funds, really provided that liquidity, and it worked. And so I could see, similar to the auctions, I mean, the market, we have the technology to create all sorts of auctions and matching of a buy-sell bid. And I think that there is a lot of room for innovation, but there's opportunities for new market players to step in and solve these problems and give investors what they need in terms of liquidity. So,
no, thank you. And Scott, you have a partnership with Mitsubishi, so to enhance the technological changes you were mentioning earlier, so that you need to be strong for operational efficiency. So can you elaborate on that?
Sure. So we do have a strategic partnership with Mitsubishi Corporation. So it's a partnership that goes back even before the founding of our firm. My partner and I had this relationship going back many, many years. And we collaborate with them to understand supply chains more fully, what's happening in the market. We can get ahead of technological changes that may be coming down the pike that have made their way to a certain part of the world but have not yet been regulated in other parts of the world, and it just makes us smarter when we're making our investments. And so when we go into some of these old line businesses that have been underinvested in previously, we have a better sense as to what the capital needs are going to be and what the innovation needs are going to be for that business. And we also have started to use AI very selectively. I think we're pretty much in the category that Andrew described. A lot of our businesses are not quite ready for full-scale AI. But for example, in some of our chemicals businesses, if we need to come up with a new molecule which has better sustainability characteristics or something like that, we have been able to selectively employ these kinds of techniques in order to innovate faster.
No, thank you, Klaus. You are a serial entrepreneur in innovation, maybe having a view on the new trends in VC for next year.
Yeah, look, so there are always some cyclical things. So I do believe that given the necessity and the sheer money going in Europe into the defense, so that a lot of companies will be additionally make business in that sector. So if you, just to give you some numbers, if the states spend 2% on defense and 5% of the defense budget goes into technology, that's roughly 70 billion market cap a year. And this will grow to 3.5 and 10%. So this is rather 250, 300 billion market cap every year. So, and there are some strategic sectors that are absolutely compulsory to have, so meaning own rocket launchers, own satellite constellations. Anyways, the whole space tech will be very, very dominant. So I do believe that, yeah, on the one hand, the technology in space, and also in general, the whole drone technologies are just at the beginning of it. So what I mean with it, for example, in space, imagine that with new hypersonic weapons, if they are equipped with nuclear warheads, the US president has like 12 minutes reaction time. So, and that will not be, you will not be able to react to that with established means. So you do have to probably have some kind of defense system being deployed in space.
Oh, thank you. We've analyzed, before we come to a wrap up, so we've analyzed the macro trends, we've analyzed geopolitics, convergence of public and private markets. We've touched on innovation. And now I would like, Andrew, you to bring this up together with something that for us is extremely important, which is governance. Governance has been treated always as the Cinderella of the investment I would also say education for Kai is very important, and we have for leadership pieces, one is on governance. But your role, because it's peculiar, because you know you operate in the private space, but you also know the governance and maybe the differences in governance in the public markets. So what's the role of governance, and final thoughts for the future?
Thank you. So governance, I think there's kind of two vectors. Let's just start with families, okay? Families that have adopted family councils and governance models, on average, have outperformed the families that don't. The data's out there, right? It's irrefutable. If we take that into the private markets, it doesn't have to be that because you're a private company, you can't have great governance. And I think so many of us have now so much experience around governance models, around reforms in that, around disclosure, around transparency, that actually I think the governance becomes the asset for the company. So for our firms, installing transformation committees, audit committees, risk compensation committees, and making that a part of the playbook with our management teams creates such a great partnership and transparency that it removes it from what was the show up once a quarter board meeting approach that many in our industry had taken in generations of the past. I think, like Scott, we have a very active operational model. So we're engaged with our companies, not just as owners and directors, but also as active and rolling up our sleeves with those companies. Coming back to it, I think you can get the best of all worlds in the private markets. You can get I don't need to tell my competitors what my playbook is, but I have a great governance model that, again, makes it more attractive for a strategic acquirer to want to come in there, because they don't need it to be a public company for that validation.
The other consideration in the private markets is whenever we sell an asset, we go through an extensive, due diligence process from the buyer, right? So if there are any, gamesmanship that's happening in the financial statements, it's going to get found out. And what's different about the public markets is that, the average investor doesn't have access to the same kinds of due diligence information when they're buying and selling public securities. And what that means is that sometimes the managers of those public companies have incentives. They can see what their stock price is on a daily basis, and they can just sort of manage to that. Whereas we have the philosophy of we need to act like we're going to own these businesses forever. So we need to make all the right decisions as if we're going to own them forever. And yet, we're fiduciaries. We wake up every day and every business is for sale at a certain price.
Absolutely.
And so it's that higher level of due diligence scrutiny that I think advantages private transactions over the public transactions.
And this fiduciary role is pretty ingrained in the Middle East. It's an area that has it's enshrined in the way, in the DNA of doing business and in investment management. So thank you so much. It has been a very great and interesting panel. An applause to you. Thank you.
Thank you.
We move.
Please remain seated as we set the stage for the next session.